Hello, everyone. Welcome to Stockertim, the investors channel. On this episode, I'll be talking about Lemonade Inc. Lemonade Inc. Is one of the tech disruptors in fintech and most especially in insurance. So, just like you have Robinhood trying to disrupt investing, stock market, brokerage side of things, Lemonade came into the market to actually look to disrupt insurance. Is Lemonade living up to that promise? Is Lemonade really putting up any good fight, especially when Lemonade is happy on the name or the theme or the strength of using AI of and automation to actually price, analyze, and also more or less do insurance and also classify risks. So, on this episode, I'll be talking about Lemonade. Is this a stock to buy or sell? Is this a stock that is likely to actually do 10x, or is this a stock that is not necessarily going to, make any dent in the industry that it looks to disrupt? So, I'll make that disclaimer. Every information shared is for education and information purpose only. Do your due diligence or consult your financial advisor before making any decision because investing carries risk to your capital. On that note, let's jump right in. So, just as an introduction to Lemonade, for so many of us who haven't been following this stock or this company, the company started a few years ago, especially during the boom that a lot of fintech companies actually saw during the lockdown, the COVID pandemic. But today, Lemonade now has a market cap of about 2.3 billion dollars. Is now positioned more or less as a mid cap kind of in short tech company. Lemonade has an enterprise value of about 2.9 billion dollars. So in terms of the market cap and the enterprise value is almost neck and neck, which means it's not very much value to the upside. The PE ratio is not very scary. It's not too aggressive, but there's so much to also look at when it comes to Lemonade. The revenue that the company actually disclosed as at the last update, Q1 2025, first quarter, about 558 million dollars in revenue, which was a growth of about between 23 to 27% year on year. Quite positive, if you must say that. Revenue per share is about 7.7 dollars per share. The company still maintains that steady kind of growth because that's one of the positive side of things for Lemonade. They seem to be very consistent, kind of quarter on quarter, growth in its revenue. Does this necessarily mean that Lemonade is a buy or is even a stock that you should short or sell? Let's still go under the hood. The net income is still negative. Lemonade actually, the net, the net income for Lemonade is about a negative of 217 million dollars. Operating income is still negative as well. About $220 million. Earnings before interest, depreciation and amortization, which is a very good way of looking at, if you strip out all the costs that a company actually incur to run the business before actually factoring out earnings before tax and depreciation. It's about a negative of 200 million dollars, which is still very negative, and the free cash flow is negative as well. So the company doesn't have a positive cash flow, which is to me not necessarily just a red flag, but something to actually bear in mind if you are an investor and you are thinking of even having Lemonade or you already have the stock. So the cash flow is quite small and it's even negative, just to say that. Operating cash flow about $29 million negative. And yes, Lemonade has a lot of cash, not necessarily too much, but some considerable level of cash, on the balance sheet, about $330 million dollars. But I'm going to say a few pointers to why this might also be at risk because of the kind of business model of Lemonade. The PE ratio, yes, is negative. About negative of 5.5 times future earnings, which means it's still not a company that is profitable at all. So the PE ratio doesn't necessarily tell us so much about the future of this business. It just tells us what this business has done in the past or what they're currently doing. But in terms of the future potential of this stock becoming a 10x opportunity, this doesn't really tell us anything much. And that's why for Lemonade, I will give them a pass when it comes to the actual valuation when it comes to PE ratio. Now, Lemonade has made a huge promise, and the promise is that the business really, really want to go forward looking to become profitable by the end of this year. Lemonade, as a matter of fact, wants to be cash flow positive by the end of 2025. They want to actually be an EBITDA, which is earnings before interest, tax, depreciation, and amortization. So all the earnings before all of those costs, all other charges are factored in. By 2026, Lemonade wants to actually be profitable. By that time, is this going to be possible? We are not too sure because the insurance business is a very, very, very tough business to actually break through, especially when you look at the bigger players, the likes of Progressive, Chubb, Allstate, AIG. These are traditional legacy insurance companies that are also looking to actually use technology, adopt AI, invest in automation. So the likes of Palantir, for instance, the AI software analytics company, is actually partnering with more insurance companies who are now using AI to price risk, to determine risk, and to also see how they can modernize and automate so many things for customers to be able to access insurance. So Lemonade is not necessarily going to be the only one trying to actually use AI in a very, very smart way to be very, very competitive and profitable. So if Lemonade says they are going to be profitable by that time, I don't necessarily see it in the horizon. I don't necessarily see it because of so many things, and I'm going to say a few things here and here and now. Does that necessarily mean I'm saying Lemonade is not a buy? Not exactly, but I'm just saying these are the things that as an investor you really, really need to look into. So what are the risks to Lemonade's profitability? Number one, and the first one is the business, the losses the business is actually incurring really, really outweighs the margin. The company doesn't necessarily make so much in terms of margin, and that margin is very thin, and in insurance 0.011% really matters in the business, because the risk of a business, insurance business, incurring so much claim due to natural disasters, due to man-made, non-man-made factors is very, very high. Insurance business might actually look very low risk from a big legacy traditional business point of view, like the likes of Chubb, Allstate, Progressive, AIG. But for a fintech driven, very, very high cost kind of business like Lemonade, every 0.01% margin actually count, and they give so much out compared to what they actually taking. Also, high valuation repair, in comparison. Yeah, I said the valuation doesn't necessarily matter, but if you look at the pathway for this business to become profitable, it's still very, very debatable if if Lemonade is able to actually keep the kind of valuation it has vis-a-vis the fact that it's not necessarily making profit, and that pathway might still be very, very far down the road, further the line. Disaster exposures, if you look at the California fires that happened earlier this year, It was very, very, actually late last year, stroke earlier this year. It was very, very terrible for a whole lot of insurance companies. They incurred so much losses, and the likes of Lemonade, being a smaller player that still has a lot of cash burn, a lot of cost, they actually incur, that really actually affected Lemonade's losses to actually spike. The fact that they will look to make profit is still really, really tied to the fact that Lemonade hasn't necessarily been able to scale. If you compare Robinhood's business, despite the fact that Robinhood doesn't necessarily even do insurance, but who says no? Who says Robinhood won't actually do that? But look at the business of Robinhood. Robinhood has been able to scale its business in the context of stock brokerage, investing, kind of universe, kind of competition. But Lemonade hasn't necessarily made a huge dent in that sector, in the insurance business, and that's one thing that I'm actually going to look at as more or less like something very concerning for me. So if you have watched this video to this point, please subscribe to our channel, put on your notification bell so that you don't miss any update. I'm going to show you two charts that actually says much about why I think investors should actually be more careful when investing in companies like Lemonade. That doesn't necessarily mean I'm saying Lemonade isn't a buy. I'm just putting it out there so that you as an investor can make more informed decision before actually doing anything. So come with me. So here is a chart done by Wall Street Millennial, one of the most respected investment and stock analysis YouTube channel. You can check them out. But I like this chart because it basically just breaks down the business model of Lemonade and why Lemonade might actually have more to deal with when it comes to its ability to actually become profitable, or its ability to actually even be competitive in the business of insurance. So if you look at this chart, it basically just shows that if Lemonade actually goes to insure the risk that it actually insures for its business. So this is how Lemonade actually operates. Lemonade doesn't necessarily take all the risks on their own. They still go to what we call reinsurance companies, and reinsurance companies actually more or less they conditionally reinsure an insurance policy based on some predetermined terms. So, e.g., if you look at this chart, if Lemonade gets any claim that is beyond a particular threshold, Lemonade will actually pass the entire risk. So if you look at this chart, it says, for any claim under this, say for instance, a customer of Lemonade actually still made a claim under $2,000. Lemonade will still have to pay the entire 1,100 in claim, and the insurance company will still make their $100, and they don't have to actually take on any risk or even pay out anything to Lemonade to reimburse them. But if you look at the other part, which is if there is any claim over 30 grand, for instance, Lemonade will only have to pay about 4,100, and the insurance company will pay about 24,900. So what this means is that if Lemonade is not able to actually break into the bigger part of the market, the high risk, the low risk and the very, very big insurance business, Lemonade doesn't necessarily have that ability to reduce its cost, to actually reduce its loss ratio. Loss ratio is basically the difference between what an insurance company takes in as premium and what they pay out as claims. So at the end of the day, the business of insurance is not necessarily being disrupted by Lemonade. From what you can see, it's more or less Lemonade trying to actually, yes, use technology to get younger people, maybe an underserved market or a market where people actually pay more for less risk. Lemonade is taking those risks, but at the end of the day, it's going to be very, very thin margin for Lemonade, and it doesn't necessarily mean Lemonade is able to actually make so much money from doing this business or even become profitable. But that is what the case is. If Lemonade changes its approach, maybe they actually want to even go a little bit offline to take on customers in the real world, not just using their app or their tech AI automation platform. Maybe the approach might actually be different, and they might actually need to actually reprice how they actually take on risk and taking premiums. But let's look at the last chart, and I'm also going to tell you what I think and what you should be doing. So here is the all-time chart of Lemonade's stock performance. As you can see, the company had its boom during the COVID pandemic, when a whole lot of people were sheltering in place, and the company really made a huge buzz. It was a huge hype, and the stock almost went to $200 per share. And since then, the stock has actually crashed, because the reality check, when a company is still new in the market, it's still going to go very high. A whole lot of speculation and all that. But Lemonade is no longer in the business of speculation. The market has really priced the stock, and you can see that it's still down by about 38%. In the last 5 years, if you check the stock performance, it's still very even more negative, about 49%, almost 50% down. But if you check the last 1 year, you could actually see that the stock really has seen some movement towards the upside, recovering very fast. Year to date, you could actually see marginally not too bad, not because it's outperformed the S&P 500. It's now up by 15% year to date. However, we really need to look at Lemonade vis-a-vis the business model and the industry where it actually plays. So here is the KIE, which is the the insurance, one of the most prominent insurance ETFs. And as you can see, just year to date, the KIE really is not doing badly, and Lemonade has outperformed it. But if you check the last 1 year, Lemonade outperformed it, but all time, maybe in the last 5 years, the KIE, has definitely outperformed Lemonade. So because investing is not necessarily the same thing as trading. So if you want to look at, okay, say for instance, the last 1 year, you might actually think, oh, the stock is doing very well. If you check the last, year to date, the last 6 months, yeah, not doing badly. But as an investor, you actually want to look at a company, from a more, not too long, from a more medium towards long term kind of trajectory, so that you can make informed decision. And that's why I'm inviting you to join our premium community, where we share well curated, well researched stock picks, not financial advice, not regulated advice. It's just our own actually stocks that we invest in, stocks that we've actually invested in over time, and stocks that we're actually looking to make better returns, at least in the medium to long term. And just for you to know, there's risk to your capital when you invest. Previous performance is not actually a guarantee of future performance as well. So if you actually interested, I will drop the link. You can see at the top of this video, you can see I'll also drop the link as well to join the community. We have daily briefing, daily newsletters that go to members about what is going on in the market, how they should position themselves in terms of building a portfolio, also how to do proper due diligence, and more importantly, more well curated content for you to actually make more informed decision and analytics behind what is going on. So that's how I'm going to close it on Lemonade. Do you actually think this is a stock you want to buy? This is a stock you want to short or own? We don't necessarily want to actually tell anyone what to do, but it's left for you. But we have actually done this review of Lemonade, and we hope that you'll be able to make your informed decision. So if you have watched this video, please give this video a like, subscribe to our channel, put on your notification bell so that you don't miss any update. On that note, thank you so much for watching this episode. If you have enjoyed this episode, please give this video a like. We'll see you in the next one. Till we meet again, keep investing, keep growing. Take care, and bye-bye. Cheers.